What's up, trading bros and sisters? Weekly review, session 37. Week 19 is in the books, and I need you to clear your afternoon because what happened this week? Not the surface level stuff. What actually happened underneath takes a real breakdown. I'm Wildcard. TB is right here. Let's get into it. Straight into the numbers, because they don't make sense until they do. The Qs, up 5.4% on the week. 3 all-time high closing records in 5 sessions. On that same week, Micron, ticker MU, runs 33%. Advanced Micro Devices, ticker AMD, runs 26%. NVIDIA, ticker NVISA DA, up 8%. And Palantir, ticker P, LAT and TR, 85% revenue growth, raised full-year guidance, beat analysts on everything they were watching. Closes the week down almost 7%.
Hold that in your head for a second. Palantir does everything right. 85% revenue growth, raised guidance, beat on every metric the street was watching, and the market sends the stock lower.
That is not a bad earnings report. That is a message from the market. Something shifted this week about what the market is willing to pay for. VIX closed at 17. Casino with no security guard, week 3 in a row. 3 record closes and an ugly underbelly nobody on the main channels was talking about.
The numbers feel wrong in isolation. They feel intentional together.
That's the week. Physics beat narrative. And we're going to spend the next 20 minutes on what that actually means. TB, walk us into the guard change.
Okay. The first mistake everyone made was calling this a good week for chip stocks. That is not what happened. The market got picky inside the sector. For the first time.
What do you mean, picky?
3 months ago, anything with artificial intelligence in the earnings call went up. Didn't matter if he made chips, made chatbots, or just said the word inference into a microphone on a conference call. The whole space got bid. That phase is over.
Because this week, NVIDIA, the king, the one that started the entire artificial intelligence hardware boom, went up 8%. On the same week, on the same catalysts, AMD goes up 26. Same artificial intelligence infrastructure spin story. Same NVIDIA investing $30 billion into OpenAI making headlines. Same Pentagon pushing artificial intelligence systems onto classified networks. And AMD tripled NVIDIA's weekly move on identical catalysts. That is not a hot sector. That is the market picking winners inside the sector.
And the picking criteria is physical bottlenecks. Micron is memory bandwidth. You cannot negotiate with physics on that. Either the memory is there or the model does not run. AMD is the alternative compute path. The what if we don't want to pay, Jensen's margins trade. Both of those are bottleneck plays. Things you can measure in gigabytes and watts.
Meanwhile, NVIDIA is still the king. Nothing changes that. But the king's premium is already in the stock. 8% on a week like this is the market saying you are great, and you are also already priced for great. That is the same message it sent to Palantir, just delivered without the 7% haircut.
Here is the connection that I keep coming back to. Anthropic crossed $1 trillion in implied valuation this week, $99 billion in annual recurring revenue. And they built a system called Mythos. It found 271 vulnerabilities in Firefox and wrote 181 working exploits. Deployed defensively through a project called Glasswing, coordinated patches with Microsoft, Oz, Apple. That is not a research demo. That is production artificial intelligence capability.
But to run Mythos at scale, to actually deploy that in production, you need Micron's memory bandwidth. You need AMD's compute. You need the cooling infrastructure that a Virginia data center did not have on Friday, when Oz overheated and took down Coinbase and FanDuel for half the afternoon.
That is the through line. The artificial intelligence that's capable enough to find 271 Firefox vulnerabilities needs the chips. That went up 33% this week to physically exist and run. Intelligence is optional. Physics is mandatory. And this week, the market started paying for mandatory.
That line is the episode. Write it down if you're listening. Okay, real talk on our own books. One beat, then we move.
Wave trader caught form factor, ticker Ford ORM. Hit both profit targets on the week. I took partial exits on the way up. Closed the cycle up about 2%. 90 position. The algo caught sector momentum and grabbed one. It just grabbed the small name instead of the monster.
T had 4 positions all week. All of them small. 90% cash. I watched Micron run from $373, where I first called the memory bottleneck thesis back in April, all the way to $745 on Friday. 100% run on a thesis I called. And I had a front row seat with no ticket.
We were both right about the direction. Neither of us sized into the move.
One beat. Moving on. Because the real economy underneath this rally was breaking, and that sets up everything else. Toyota profit dropped 49% from tariff damage. Nintendo hiked the Switch 2 from $450 to $500 because of the memory component crunch. British Airways out there warning on jet fuel costs from the war. The market did not flinch on any of it. 3 all-time highs. VIX at 17. All of that sets up the NACHO argument. TB, you and I actually disagreed on Friday about what oil was telling us. Let's get into it.
Walk me through your read because I want to understand where you landed.
Whoa. Hormuz is closed. The United States struck 2 Iranian tankers on Friday. Rubio put a peace framework out. Expected a response from Iran? Got nothing. This is week 9 of me calling the ceasefire a trap. 9 for 9. And oil dropped 4.3% on the week, from $99.73 to $95.42. Gold went up 3% on that same week. Explain that.
My first read was that the oil drop meant the market was pricing some probability of peace arriving. Geopolitical risk cooling, even if the situation on the ground hadn't changed.
And I push back hard on that. Because I think gold and oil are not contradicting each other. They are pricing 2 different things simultaneously.
Go.
Gold is pricing inflation and geopolitical risk. The war is real. Tariff chaos is real. Food prices at 3-year highs. Jet fuel costs crushing airlines. The fear trade is working exactly like it should. Gold goes up. That is the signal you would expect.
And oil is pricing something different.
Demand destruction. Toyota's 49% profit drop is not just a headline. That is actual trucks not being built. Actual steel not being smelted. Actual fuel not being burned. Ships are moving less cargo because tariffs are choking global trade routes. Airlines are cutting flights because of fuel cost warnings. The global economy is physically consuming less oil right now. Supply disruption from Hormuz is real. Demand destruction from tariff damage is also real. And right now, demand destruction is winning the math.
Oil drops not because peace is coming. It drops because global slowdown is offsetting the supply crunch.
They are not disagreeing. They are both saying this is bad. Oil says it is bad for demand. Gold says it is bad for everything.
That is where I landed by Friday afternoon. You're right on that reading. But here is the part that worries me. Demand destruction is buying time. That is all it is doing. There are 3,200 vessels queued outside Hormuz right now. Reserves draw down every day the strait stays closed. Buffers don't regenerate while the closure holds.
And when the buffer math breaks, oil does not gradually climb back up. It snaps.
Hard and fast. And someone in the market has already run that math.
The $900 million oil short placed at 3 in the morning. The Justice Department probe is the sideshow on that story. The trade is the story. Someone put $900 million on a single oil position in the middle of the night. That is either a thesis on when the demand destruction buffer breaks or a thesis on when peace actually arrives. Neither of those is retail money.
Incor Energy, ticker U. Wide stop. Entry at $23.24. Stop at $12.31. Not adding to the position.
Long the oil snap happening before the stop gets hit. That is the honest position. My timeline is 4 to 6 weeks before the buffer math forces a repricing. If tariff damage accelerates and kills demand faster, you maybe stretch it to 8 weeks. But here is the alignment that keeps me up. The Trump-European Union tariff deadline lands on July 4th. That is trigger 2 and potentially trigger 1 firing in the same window. Which brings us to Michael Burry.
Buffers deplete. They don't regenerate while the strait is closed.
All right. Yeah, Burry.
On the same Friday as the third all-time high weekly close, Burry tweets that this feels like the last months of the 1999 to 2000 bubble. And you can see why he reached for that frame.
I can. Palantir at 43 times forward sales. Anthropic at $1 trillion implied valuation on $99 billion in annual recurring revenue. The multiples look stretched. But I think the bubble frame is wrong. A bubble has no underlying value. Pets.com. Webvan. You could not measure the value because there was not any. This is different.
What is the distinction?
Micron went up 33% on real demand for real memory bandwidth. The data center capex going in right now is real infrastructure. You can physically touch the servers. The Virginia data center that overheated Friday is a real building. The value is there. The question is whether the price is right for when that value fully arrives. The capex is real. The valuations are 1999 stretched. It is not a bubble. It is a tether. The value exists. The question is whether the rope is long enough to reach it before something snaps.
And the Fed is the clock on that tether. Normally, when multiples stretch this far, the Fed eventually cuts rates. Cost of capital drops. The escape valve opens and gives the market room to grow into the multiples over time.
The jobs report Friday welded that valve shut.
115,000 jobs added. Good hiring numbers. CNBC saying on air that the Fed is running out of reasons to cut. And here is the mechanism that makes this particular setup worse than 99 in one way. Good economy means no rate cuts. No rate cuts means elevated cost of capital. Elevated cost of capital means multiple compression math gets harder every quarter. But the good economy is also what is producing the earnings growth driving the rally in the first place. The rally needs rate relief to hold the multiples. The good economy prevents the rate relief.
Success is feeding the setup for failure.
Burry is right about the symptom. The mechanism is what he did not spell out. The Fed is pinned in a way it was not in 99. Greenspan had room to cut then. The next Fed chair inherits an economy running hot on real artificial intelligence infrastructure earnings with embedded inflation. No room to move. The tether gets shorter every quarter the economy holds firm and rates stay high.
3 triggers. Ranked by how fast they could fire. Fastest is trigger 2, the oil snap. 4 to 6 weeks on the buffer depletion math. Strait stays closed, reserves keep drawing down, and demand destruction stops being enough to offset the supply squeeze. Oil reprices hard. That is an inflation shock on top of an already pinned Fed. Consumer demand gets crushed. Both sides of the tether hit simultaneously, the multiples and the earnings trajectory that was supposed to justify them.
Middle timeline is trigger 1, tariff damage spreading into United States tech supply chains. Toyota showed the template, 49% profit drop from tariff exposure. When that math shows up in Q3 and Q4 earnings guidance from tech names, you cannot narrative away a number on a conference call.
And slowest is trigger 3, the IPO window. Cerebra's is pricing. If the major artificial intelligence infrastructure IPOs price rich and then trade badly, watch the narrative, multiple names for sympathy compression. False story at the earliest. But it poisons the sentiment.
The Amish caveat.
Yeah. Burry has been calling this for 6 months. Every single week, there is a legitimate reason the market should pull back. Every week, the cues go up. The narrative shield is strong, and we cannot tell you which week the trigger actually fires. 2 guys who called the thesis and mostly watched from cash do not have the week dialed in.
Gold sees the timer. That is true even when you cannot read the exact time.
Gold sees the timer. All right. What does someone actually do with all of this?
3 things. First, do not chase. Micron at $745. IMD after a 26% week. The thesis is right. The entry is gone. Buying here is buying froth. If you missed it, own it and wait.
I own it. 90% cash all week. Cash kept me safe. Cash also kept me out of the biggest move I have ever called. Both of those are true at the same time.
Second, build the shopping list now. Not during the correction. During the correction, you will talk yourself out of it. Know what you would buy and at what price before the volatility shows up. Micron at $600. IMD at $350. The physics beats narrative thesis does not die in a 15 to 20% correction. It gets cheaper.
What does Wave Trader say right now on conditions?
VIX rate of change at 0.2. Gate is open. Clear conditions to trade. When Trader 2 fires and VIX pushes through 30, that gate closes automatically. That is engineering, not fear. Match your position size to the thesis, not to how exciting the week felt.
Third,
Cash is a position, not a failure mode. A strategy.
Week 20. Fast flags. What to watch?
Iran responds to Rubio's framework. No response means week 10 of the ceasefire trap confirmed. That is the NACHO thesis holding for another week. Watch for any sign that actually shifts that read.
Oil price action. Watch $93 as the demand destruction floor and $105 as the ceiling. Is demand destruction still winning the math? Or does the buffer depletion start showing up in price?
Energy fuels. Stop at $12.31. Not adding. Either the oil move pushes commodity fear into the position or the thesis needs a rethink.
Fed language. Any higher for longer framing in Fed communications this week starts repricing how long elevated rates stay elevated. Watch the actual words, not just the headlines about the words.
Cerebra's IPO price range. First week trading. If it prices rich and trades badly, watch how narrative multiple artificial intelligence names respond. That is the early read on whether the IPO window is still open.
And Monday rule. Clean boards, fresh data, no assumptions carried from this week. Standing rule. We do not drag last week's conviction into Monday's tape.
Standing rule. We spent 20 minutes talking about physics beating narrative. And we are 2 guys who have never met in person, talking into microphones, mostly watching from the bench. Narrative matters. It is just not worth 43 times forward sales.
37 sessions. Write about everything except the part that makes money. Nothing we said today is financial advice. May your buffers be deep and your stops be wide. See you Monday, trading family.
See you Monday.